Hello, everybody. Welcome to Story Trading special event, October 21st. We got Sammy Simnegar from Fidelity Investments here. Before we go through that, I'm going to read a disclaimer and a little bit of an overview of Story Trading. So you can take a minute to read this. Just want to point out Story Trading is not an investment advisor. Investing in securities involves significant risk of loss. And for this meeting, we are recording this meeting, and it may be posted in social media or other places in the future. So what is Story Trading for those of you who are new here? Story Trading is an investor network which aims to level the playing field with Wall Street insiders through crowdsourced collaboration to discover the hidden story behind the trade. And when we talk about that hidden story, we're looking at four components, not just fundamentals, but we're also looking at catalysts, sentiment, and technicals. And that's what Story Trading is all about. So how do you participate in Story Trading? We got a free plan and we got a paid plan as well. So if you go to storytrading.com, you click on groups or you click on join over there, you'll see some free WhatsApp trading groups you can join focused on different topics. There's probably 5 or 6 free groups you can choose from. If you upgrade to a paid membership, you get access to 50+ research groups where we collaborate on investigative research. A lot of these research groups are for specific stocks. Most of them are. Some are for specific topics like the COVID economy. Also, when you upgrade to a paid membership, you get access to Zoom events, which happen twice a week, every Sunday night at 9 p.m. and every Wednesday at 4:30 p.m. Eastern. At these Zoom events, we have members presenting different stocks. We also have, which is new the last couple months, we've had executive presentations. We're talking about CEOs, CFOs of publicly traded companies. We've already had Smith Micro, Identiv, INVE, Dario Health, DRIO, and Quintera just this past week. We also do a trade of the week competition every Sunday night where it's a user-generated kind of ideas come from the community. People vote on it. We try to help each other choose what the best stocks are to trade for that week. And here are the results. These are the featured presentations from people within our community. And you can see the average return is 24% from the time they were chosen. And that's just all recent here in the summer. 200% summer, SUMR is a top pick from Mark and goes all the way down. You can see the returns over here. So we've done a great job on our featured presentations for our community. And then we have the trade of the week results over here, our little fun competition. These are the winners every week. Every single week, someone managed to find a gain on a stock. We did great over the summer with all the COVID stocks, a little bit of a harder time in the last month, but we'll get it going again soon. And these are the wins, the people who chose the top trade for that week. So we're about to get started with Sammy. Just want to mention after his presentation, stay tuned afterwards. We got our upcoming event schedule we want to talk about. Sunday night, we got 2 presentations. We want to give you the details on that. Also, we got a special discount. If you're not a paid member, we'll give you information on how to upgrade for a big discount. And also want to let you know how to participate in the success of our company, the Story Trading Company. We got a couple exciting ways to do that. And with that, I want to turn it over to, let me just introduce Sammy Simnegar. He's a fund manager at Fidelity. There's been a number of funds I know he's been managing, most recently Fidelity Magellan, which is the one a lot of people are familiar with. So Sammy, I'll let you take it over from here and introduce yourself a bit further. Thank you for coming, by the way.
Great. Thank you, Ben. Thank you, everyone, for joining today, especially family and friends. It's really an honor and privilege to be here and sharing some insights with you guys. Just by way of background, I was actually born in Iran. I came to America when I was 6 years old. I grew up in California. I was a history major in college, didn't really know much about investing. I read a few books that made me interested in the markets. One was called Barbarians at the Gate, which was about the takeover of RGR Nabisco, and then one was called Den of Thieves, which was about all of the insider trading that was happening in the 80s. It actually piqued my interest, and after I went to business school, I ended up at Fidelity on the real estate team. I was looking at real estate. I was an analyst, hotels, real estate. I looked at some telecom companies as well. After that stint, after 2 to 3 years, I moved on to the role of looking at banks, regional banks. And after regional banks, I moved to the emerging market team, looking at energy, industrials, and materials. And then from January of 2008 until the present, I've been managing the Fidelity International Capital Appreciation Fund. Then from 2012 to 2019, I was managing the Fidelity Emerging Market Funds. And from January of this year, I've been managing Magellan and Independence funds. So that's basically what I've been doing in terms of my journey to my job. What I do day to day, I'm visiting with it used to be in person, now virtually, with companies, hearing their stories, what they're doing, talk to my analysts who look at these companies for us, as well as join meetings with people on the sell side who, in my opinion, there are a lot of talented people, and everywhere you can learn and understand what's happening, give you some type of insight is definitely worthwhile. So I would say those are some of the introductory comments I would make. Ben and I spoke a little bit before. We're going to do a Q&A session in terms of he'll ask me some questions, I'll answer them, and then down the road, I'm sure we're going to open it up to questions for everyone else. Just in terms of the things I can talk about and things I can't talk about, I'm not going to talk about anything that's going to work for 1 week. If you look at my holdings, I can talk about all the publicly disclosed holdings that are available that you guys can see online. You feel free to ask me about those. I can talk to you about my opinions on the markets, what's happening, and whatever else I can do to help. I'm happy to share. Thank you.
Great, Sammy. All right, good. So that means we got a lot of time for Q&A. So let me start with those topics I put out there before. Actually, I'm going to throw one out to you before that I didn't tell you about. But what this, Magellan, managing that fund, there's obviously has that history with Peter Lynch. And I'm wondering, internally at Fidelity, is that something does it have like a brand internally in the company? Did you have to, do they kind of honor that history there, or do you have to do something special that you're at Magellan now? Like, if you can tell us a little about the Magellan fund and how that's looked at internally at the company.
Right. No, that's a great question to start. So, Magellan was really associated not only with Fidelity, but with, I would say, personal investing. In the 80s, Peter Lynch made investing very accessible with the books he wrote, talking about buying what you know and so forth. So I would say a lot of the franchise that Fidelity's was built around Magellan, especially in the 80s. To give you perspective, I joined Fidelity in 98. In the year 2000, the Magellan fund surpassed 100 billion in assets. And so it was the largest mutual fund. Since then, it's gone down. As of now, it's around 20 billion or so. And the Contra fund during that same time period has now is about 170 billion. So the Contra fund is now, in my view, obviously the main fund of Fidelity. It was very broad. We have many assets, but I would say that's probably the largest and the most well-known today. But the process by which I was selected was one where I had to go through an internal process. Other people were interviewed, and based on what they thought the fund needed in terms of strategy, my track record and so forth, they asked me to take over, and that's how I got to be the fund manager.
Cool. Great. Thank you for that. So yeah, first question has to do, story trading, our crying call, our mantra is level the playing field with Wall Street insiders. That's really what we're motivated by, right? So there's definitely this feeling by retail investors, the deck is stacked against them. And I'm sure you might say that's true, I can imagine. So just wanted, from your perspective, what are the type of resources you have at your disposal, which might, discourage someone from investing on their own, or maybe it doesn't, but we'd love your perspective on that, maybe in terms of staff who work under you, paid data services, market research data, access to management. What are those type of advantages that someone like you would have?
Yeah, I would say the single most important access that we have that individual investors don't have, and now to be fair, individual investors, by buying our mutual funds, hire us to do that on their behalf, is to meet with executives. So, we would, for example, get to meet with Jamie Dimon from JP Morgan. We would get to meet maybe with Mark Zuckerberg when we go to visit Facebook. So those are things that not everyone gets to do, obviously. Having said that, with a lot of regulations trying to level the playing field, a lot of the information that's available to us is available to you on the websites, investor presentations. You can see recordings of public appearances that the management teams have had. You can read their 10Qs, the 10Ks. You can follow, you have information and so forth. So I would say in general, probably the only source of differentiation would be visiting with the senior management teams. The other thing I would say, we probably have resources to go and kick the tires probably more than you guys do. For example, if we're thinking about investing in GM, we can probably go visit the factory. It'll be hard for you guys to visit the factory. Now, whether that actually gives you an edge or not, we can debate that. But I would say that would be something else. Just the resources we have to travel, meet with companies, competitors, and so forth is probably also, I would say, differentiation. differentiator between us and the individual investor.
Okay, great. And market research data, is that something you rely on? Third-party data?
Yeah, I mean, I'll tell you something that's very interesting. With all the big data and all the algorithms and all the quants that are out there now, information gets scraped and reflected in stock prices very quickly. So let me give you a small example. Nowadays, before the market opens, a company will issue a press release, and you'll have market research or AI go and say, okay, are they, do you see the word reduce? In other words, reduce estimates, or increasing our estimates, or things are getting better, or things are getting worse. And they look at all this and they actually trade on this information. Credit card data, when credit card data comes out, hotspots, retail, which retailers are doing better than others. So all of this tends to get reflected very, very quickly in stock prices. So in terms of market data, I really don't think there's a big edge because it does get reflected by other market participants.
Okay, cool. And then regarding your access to management, as you said, most of all that information is available in the 10Qs and the SEC filings, and they're not going to give you a heads up on what earnings will be or something, right? That's inside info.
No,
So
of course,
what is it that
not.
you're actually trying to assess when you speak to management?
Yes. Yeah. Now, obviously, everyone's going to tell you something different. What I'm trying to do is trying to understand the vision of the company. What are they trying to accomplish? What's driving them? What you'll find is, for example, if you meet with Jeff Bezos, his mantra has been better, cheaper, faster. That's what he wants to do. Now, if you believe in that strategy and you think he can deliver the strategy, every time the stock price pulls back, you're like, well, I know what he's trying to do. I think he's better, he's cheaper, and he's faster than the competitors. He's building an immense network that's going to be very difficult to replicate. He's building big barriers to entry. He has demand on e-commerce and AWS driving the business. So I want to invest with him. So oftentimes what you really want to get is the vision, where they're coming from, where they're going, and their ability to execute the plan, the management team around them, and so forth. So in my view, it's really to get the 3 to 5 year story and where you think the earnings trajectory of the company is going to be.
Okay, great. Let's move over to the next topic, which is risk management and how you look at allocation. And I'll actually throw out a specific example that's come up in our community that we've been debating the last week or so. Let's say you have a holding that does really well, outperforms dramatically by your other holdings. Maybe you find a stock that goes up 100, 200, 300, 400% in less than a year, and it becomes over allocated. Yet you think from a valuation perspective, it has a lot more to go. So when you look at allocation, are you looking at the current allocation or the invested allocation? If you understand my question.
Yes, absolutely. Yeah. So what you'll find is different points of view. The way I manage money, I employ what's called an equal active strategy, which means that all of my overweights are the same. So if I initiate a position and it's call it 1% of my fund and it becomes 1.5%, I always pair it back to 1%. I want all of my weights to be the same because I don't think I'm particularly good at selling the winners or buying the losers. I think what I'm good at is identifying great businesses and holding on to them over time. That's relatively unique in my company. A lot of other portfolio managers don't do that. So there's one particular portfolio manager who bought NVDA 5, 6, 7 years ago. He put 1/3% of his fund in NVIDIA, and now it's about 7 or 8% of his fund because he doesn't sell. He also bought Shopify. He put 1/10 of 1%, 10 basis points in Shopify, and that's 3% of his fund. So there's others that just let them ride, and the other ones they'll trim or sell. I have other people who told me, "Oh, I bought Amazon at 300, I sold it 600, and I didn't buy it back, and I regret it." So you have all kinds of different ways of managing money and position sizes.
And how often do you do that reallocation of something, as you said, goes from 1 to 1.5?
I mean, I'm probably reallocating every week and a half.
Oh, wow.
Yeah, but it's not that much. We're talking about 5 to 10 basis points in each position, so relatively small.
Okay.
For those of you who don't know, 100 basis points is 1%. So when I said 10 basis points, that's 1/10 of 1%.
Great, thank you. Any other kind of advice you can give to people who are managing their own portfolios, which you're talking about when you deal with billions of dollars, I can probably have more positions. I don't know, but what kind of advice do you give to people who are managing their own portfolios in terms of risk management and allocation?
So I'll tell you, there's two types of individual investors that I met over time that have been highly successful. One is one of my friends who actually passed away a few years ago, a very generous person, gave a lot of money to charity, and he had a very large portfolio. And I asked him how he became so successful. He said, every time I have money, I go and I find companies that have been consistently growing their dividends, and I buy them. And what I realize is over time, you might buy something at a 2 or 3% dividend yield, but 3-4 years later, it'll be a 4 or 5% dividend yield. So I just look for dividend growth. So what we call the dividend aristocrats. And I think that's a very powerful strategy. The other strategy that I've seen that people have been very successful with is buy what you know. People who have owned Apple or Amazon or Facebook or products they use that are relatively easy to understand. What I have found people to be the least successful, even though they talk about this a lot, is I bought this $2 stock, it went to 30. But for every one of those, there's probably 10 other ones that you lost money on. You know, some people think of the stock market as a casino, and the more you think of it as a casino, the more speculative it is. But the more you think that over time the markets tend to rise and good companies tend to do well, and you buy what you know and what you understand, and don't worry about it so much, I think that's the best advice I can give to people.
Great. Thank you so much. All right. Last topic here that I have is a very exciting one because it's what we do a lot of focus on is megatrends, trends. I saw in a video that was posted on YouTube, I was surprised. It's like, you look at megatrends. I'm like, wow, that's cool. We look at trends too. Catalysts, sentiment. These are all things that for story trading, because, there seems to be a disconnect out there in the stock market in terms of fundamental value and actual trading, actual stock, actual price that it's trading at. And we think story trading believes that differential is because of things like catalyst, sentiment, and trends. Like, Tesla is always perpetually overvalued. It's probably because the sentiment of, for Elon Musk is we think he'll come up with all kinds of other revenue streams in the future. So I'm just willing to bet on him. And so the spreadsheet doesn't make sense. Like, so how do you as a portfolio manager for Fidelity, do you even consider COVID trend, for example, or police rioting trends, or
Right.
or trend of green energy stocks if Biden wins? Do you look at trends? Do you time your investments based on catalysts over the next several quarters? And do you look at sentiment at all?
Yeah. So let's go one by one. Sentiment, I think, are you talking about like charts and momentum?
No, I'm talking about like sentiment of particular industries or management that this management has a good reputation, a bad reputation.
Right. Okay, I understand. Yeah. So mega trends are very critical to the way I invest. And the reason is very simple. If you have the wind at your back, and if the portfolio you own are naturally going to grow 5, 6, 7% because of digitization, cash to cashless. For example, Visa, MasterCard, just from people moving from cash to cashless, they're gonna grow. People moving from increasingly buying online, they're gonna benefit. Green energy, even if Biden does not win, and this is what people aren't talking about, and it's very, very important to understand. Green energy today in the United States, without subsidies, is economically viable. So wind projects, solar projects today are viable. You talk to companies today like Nextera Energy, ticker is NEE. Nextera Energy is talking about their projects today make economic sense. They're going to be delivered in 2022, 2023. And so that's already going to happen. Whether Biden wins or not, it's actually irrelevant. Yes, there might be an acceleration, there might be subsidies, but we don't even need it. We're moving in that direction aggressively. Interest rates are very low. Green energy is taking off. And the flip side is you have massive tailwinds for wind and solar. You have massive headwinds, in my view, for coal, oil. Oil, not only is it dirty, but also electric vehicles are going to, in my view, massively dent demand for oil. So what is the terminal value of an oil company? What is an oil company worth in 10, 20 years when the demand for oil might be significantly lower than where it is today? Another trend is electric vehicles. So I talked a little about this, but you want to buy Tesla? We can talk about it. I don't own Tesla. I think it's very overvalued. We can talk about why. And I think the premium you're paying for Elon to come up with other revenue and profit sources is exceedingly high. On the other hand, if you look at in Korea, you have two of the largest electric vehicle battery companies. One is called LG Chemical. The other one is called Samsung SDI. And these companies are benefiting a lot from electric vehicles. Just to give you a perspective, outside of China, because China is dominated by a company called CATL, outside of China, LG Chem has about 50% market share for electric vehicles, and Samsung SDI has about 25% market share for electric vehicles. Samsung SDI supplies the Germans, Volkswagen, Daimler, BMW. LG Chem basically supplies everyone else. The other thing you need to know is no one wants to be exclusive, so they want to have dual sourcing in case one of them can't supply the product. So they're both going to benefit from this. The percent market share of electric vehicles this year is about 2%, but incremental market share in a place like Germany or China is double digits for new car sales. So if over the next 10 years, electric vehicles are going to go from 2% to 20, 30, 40%, all these companies are going to benefit dramatically. And so I'm spending a lot of my time trying to find what are the best plays on these themes: renewable energy, electric vehicles, digitization, and so forth.
Oh, that's great. So that's Megatrends. So when you talk about trends, you're talking about trends over multiple years.
Exactly right. That's right.
I don't know, just your opinion with what's been happening with COVID and the stocks that have benefited from
Yeah.
COVID. Do you also
Actually,
see that as a multi-year trend?
So this is a very, very big source of debate and tension in the market today. Let me give you an example. Hotels and restaurants. Historically, restaurants and hotel companies would tell you we grow through two ways: unit growth, we're adding more units, adding more hotels, adding more restaurants, and number two, price, or average daily rate for hotels or same store sales for restaurants. I don't know about you guys, but if this COVID environment lasts another year or two and people get used to ordering in more, in fact, I just talked to a friend yesterday who said they own two restaurants in New York City. They said September was their highest profit ever in their hotel business. Why? Even though revenues are down 30%, they have less employees. They renegotiated the rent with the landlord, and their delivery fees by law now have gone from 30% to 15%. So they're very, very profitable. Now, if you're a big restaurant chain, if you're going to have delivery be the bulk of your business, do you need as many units? And therefore, are you going to have that unit growth story? If I don't know about you guys, I don't know if we need a lot more hotels in this country or in the world. Maybe in China, but in the US or Germany, I don't know. So what happens to the unit growth story? So this is a debate in the market. People talk about the COVID recovery trade, air travel, aerospace, and so forth, hotels, restaurants. But the question is there going to be a change in the story? And a lot of it depends on the trajectory of the recovery, whether people's behavior actually changes or not. Another example would be urbanization to suburbanization. Over the last decade, it was urbanization. What happens if now we have suburbanization? What does that mean for real estate? If people buy more suburban homes and they're going to spend money to, upgrade them and so forth, maybe that's positive for Lowe's and Home Depot, right? So there's lots of these trends that are happening, and the duration of the trends and the magnitude of the trends is going to determine a lot of the winners and losers.
Great, wonderful. We got two more. Catalysts. Do you ever time your decisions, overweight or underweight, if you think that, let's say, Alibaba, company you already know that you may have a core position in, what do you say? I'm going overweight this quarter because I expect a lot of great news in the next 2 or 3 quarters.
I don't do that, no.
You don't? And
No.
do other fund managers do that?
Some people do. Yeah, some people will say, I think they're going to have a good quarter, I'll go overweight. I think they're going to have a bad quarter, I'll go underweight. Yes, some people do that.
Interesting. Okay.
Just to give you perspective, in Magellan, I have about 75 positions. In an international cap app, I have about 100 positions. So honestly, I don't have time to think about when the catalysts are coming or going. And oftentimes they're already reflected in the stock price beforehand.
Cool. All right. The last one I had here was sentiment, especially when we're talking about sentiment of management. How do you weigh that versus, let's say, the financial model or the spreadsheet looks good, but you meet management and you're not so impressed with them? How do you weigh that?
That's a great question.
Or the opposite?
It's a very good question. Ideally, you want to have a track record, and when you meet the management team, you're like, wow, these people know what they're doing, right? Those are the best ones. And then you can buy it at a reasonable valuation. Great companies are never cheap. If they're cheap, there's a problem. So always remember that in the market. What you sometimes find, I'd rather own a company that has really good financials and a relatively sleepy management than a company that has okay management, okay financials and a very slick management. Because I think at the end of the day, the numbers, if you do your job, the numbers don't really lie so much. So sometimes you have a management team that can't explain the story, but they know how to run the business, and they understand what they're doing. They understand how to create value. And they tend to be better stocks than companies that historically haven't been so good, but they'll get a promotional CEO who'll come tell a good story, but then 2 to 3 years later, they can't implement the plan because it's just not a great business.
Mm-hmm. Okay, so you tend to put more weight on the financials and less on sizing up management team.
Yes.
Cool, great, awesome. So that's all the questions I had. Ben Resnick, our intern from Rutgers University, is on here. If you can hop on the line, we're actually going to open it for Q&A since we have a little bit more time than I imagined because Sammy jumped right into Q&A. So we got about 15 minutes. So Ben, I think you can open it up to, let people raise their hands and they can put them on video or audio if they'd like. And if, people prefer to just put it in chat, you could do that as well. So Ben, I'll let you take it from here.
Sure. So to raise your hand, you go to the participant tab, and then on the bottom, you could raise your hand there, and I'll give you a chance to ask the question, or you can put it in the chat and I'll see it as well.
I think there was already one in chat from earlier. From Arash, she said, it says, so someone asked a question earlier while you were talking about dividend stocks. Do you have an ever updating list of dividend stocks that you follow?
The answer is I don't. We have dividend oriented strategies, dividend income fund and so forth. And there's, they're actually ETFs that are dividend aristocrat ETFs that you could buy. So I would recommend either buying a Fidelity dividend fund or buying the aristocrat.
Okay, great. Thank you.
I have a question. So I'm curious, when you're meeting with management at different companies, how do you evaluate while you're talking to them?
In terms of their credibility, their plans and so forth?
Yeah, just all over. You mentioned that you could have that opportunity.
The most important thing I want to know is if they're honest. That's the single most important thing, because what you want is to have a rapport with the management team and a trust with them where you call them. For example, I've been at Fidelity 22 years. I have a few CEOs that I've been in touch with the entire time. I can pick up the phone and I can call them. They'll take my phone calls. We'll talk. We'll schmooze. And the reason we have good relationships is because they've always been honest with me, and I was always honest with them. When they say, why don't you own my shares? I'll say X, Y, and Z. And when I say how's business, they'll say lousy. And so that's really, really important. Or when it's great, they say it's great. And so having honesty is the single most important thing I'm looking for. If they say things are going well, we're taking market share and so forth, and then 2 quarters later, you see that the opposite is happening, I usually will not invest in that stock again because I just can't trust them. On the flip side, if they deliver, they say, here's a strategic plan, here are financial numbers that we're trying to achieve over the next 2 or 3 years, and they do it, that creates credibility. So that trust and credibility is the single most important thing I'm looking for.
Sammy, do they stay in the penalty box forever in that case where they violated the trust?
For me, yes.
Okay, cool.
Thank you. Michael, I see
Sure.
your hand is raised. I'm going to unmute you right now.
Yeah, hi. First of all, I just want to say it's great listening to you. I had a quick question. So I listen to Bloomberg Radio a lot, and they have a lot of different economists talk about how about the upcoming election, talking about which candidate, what would not what their impact on the economy is, but how will the stock market, how will the stock market react to who wins? And I kind of want to hear what your thoughts on that are.
Yep. Okay. Yeah, sure. So first of all, you always have to remember that stock prices follow earnings and the stock market follows earnings. So under the potential Biden plan, tax rates go up from 21% to 28%. And that has basically a 5 to 7% earnings hit. Okay. Now, here's the irony, and it's going to be a little bit complicated, but just bear with me for a minute. I think if Trump wins, the market's going to go up because the market's going to say, pro-business, pro-economy, pro-growth. I think if Biden sweeps, if the Democrats sweep, the market's going to, in my view, probably go down because it's going to depend on who he chooses. If he chooses Elizabeth Warren and Bernie Sanders in his cabinet, the market's going to go down a lot. If he chooses more moderate people, I think the market's going to kind of recover. And I think if the Republicans take the Senate and the Democrats take the presidency and the House, the market also goes up, because chances are the tax rates won't go up with a Republican Senate. Having said all that, I think if we have a decisive victory by the Democrats, I don't think it's going to happen by the Republicans, but by Democrats, there's a chance the market rallies, because one of the things the market's also a little bit concerned about is having a contested election and uncertainty. The market hates uncertainty. So in a way, having a decisive victory might be better potentially in the short run, but depending on what the cabinet looks like for a Biden administration, the market, could potentially sell off. But that's kind of what I'm thinking. I think that's pretty much consensus right now in terms of the way the market's likely to react. I also want to note that always remember that over time, historically, these things haven't mattered that much as long as the earnings and the fundamentals of companies and the markets don't change that much. So what I would be looking for as an investor myself, and I would recommend to everyone here, is to make sure that the companies you're investing in can grow and are not going to be disproportionately impacted by regulation, tax rates, and so forth. Because again, if we have a Democratic administration, there could be more regulation, for example, on the banks, tax rates could go up, and that could be negative for certain sectors in the market.
I'd like to ask a follow-up question to that. We haven't seen the market, usually markets anticipate that kind of stuff. We haven't seen the market go down a lot. So, that's been a curious thing to me, because the conventional wisdom, at least in the media and everything, is Biden has a much greater chance of winning if you look at the polls. So how come, if that's true, if what you're saying is true, if Biden is bad for the markets, why haven't we seen that priced into the market already the last few weeks?
Because if you think about the market's been going up the last few weeks, it actually coincided with Biden's lead widening. And as the market's thinking now it's going to be more of a decisive victory, it's going to be less uncertain. I think that's what's happening. Whereas when the gap was 4 or 5 points, a lot of people could have said, look, this is just noise and within the margin of error, and the shy Trump voter might come out and vote in size, and that might take the election. But now that looks less likely, and it's less likely to be something that's going to be contested.
Okay, sure, thanks. I do have a question that came in over email before the call, coming from Jeff Taylor. He says Fidelity had done a study as to which accounts had done the best at Fidelity, and what they found was they were the accounts of people who forgot they had an account at Fidelity. In other words, the accounts were untouched for many years. Did Fidelity, in fact, report such a study? And would you like to elaborate on it if you're aware of it?
Okay, I don't know anything about it, but it doesn't surprise me at all. I'll tell you a stat that was done by Credit Suisse, which I thought was actually fascinating. They did a 10-year study that ended 2016, so the 10 years trailing. During that time, the S&P gave you an annualized return of 7%. They looked at people who had bought and sold the Vanguard S&P 500 ETF, and the average realized return of the people who had bought and sold the Vanguard was 3.5%. Meanwhile, the average return of a mutual fund investor was 5 or 5.5%. So what that actually told you was people who were buying and selling the ETF only made half the return of the actual market, and you were better off owning an underperforming mutual fund that you held onto because you had a broker or someone holding your hand and keeping you in the market than actually trying to trade the ETF yourself. So in general, people are very poor traders. Why? The market goes up, they get excited, they want to buy, and the market goes down, they want to sell. If you go back, and this I do know, if you went back and you looked at the people who sold in 2008, a large percentage of them did not buy back in 2009 or 2010. They just stayed out. And so the massive opportunity cost during that time period. So again, stay invested. The other thing I always tell everyone is do not try to time the market. Dollar cost average your way in every month, put in a little bit. Don't try to time the market.
Great, thank you. Ben, any other questions? This is just give it like one last chance here.
I got a question, Ben.
Oh, Rob, you're here. Great.
Yeah.
Rob works with me at StoryTrading. I know he had a conflict, so he may have joined a little bit late. Hey, did he hear all the EV talk, the Megatrends on electric vehicles? I know you're a big proponent of that. You'll have to listen to
that's actually what I'm interested in.
Recording if you weren't here for that. Go ahead.
Go ahead, Rob.
So I'm definitely interested in predicting future behavior of groups of people in society and trading that way. So can you elaborate, if you're allowed to, on some of the methods you use to predict future behavior of society to trade on?
I mean, that's as close to impossible as possible, right? I mean, it's very difficult. I mean, it's hard to predict the behavior of my wife or my kids, let alone society. Look, I think there are certain trends. I mean, I think most reasonable people would today conclude that renewable energy is going to grow over the next 5 to 10 years. I think most reasonable people would conclude that electric vehicles are going to increase over the next 5 to 10 years. I think most people would conclude that, you know, when we look at society, there's going to be some type of give and take between the wealth dispersion that's happened and discrepancy that's happened. So I think these are the things I think about. Where I have high conviction are places where I feel like trends are already in motion. So I don't say I hope this happens and that's why I'm positioned for it. I wait for it to already start moving in that direction, and that's when I increase my positions and my bets around those themes. And that's kind of what I would recommend: is don't try to be smarter than everyone else and be the first one to get in. I like to say I like to buy stocks in the second or third inning, not the first inning. And so you want to make sure things are already moving in that direction.
Makes sense. I agree with that.
And again, another high conviction, we're going to consume less oil, less coal in the next 10, 20 years than we are today. And what does that mean? You know, there's lots of industries that are going to be severely impacted by this. What does it mean for geopolitics? Well, what does it mean for Saudi Arabia and Russia and Venezuela and Iran if oil prices getting cut in half in real terms over the next 10 years because of demand? It's very interesting. By the way, this is something that the U.S. and China should be cooperating a lot more on, is if the U.S. and China are able to both push electric vehicles aggressively, because we're both net, you know, well, the U.S. became a net exporter of oil, but historically we were a net importer of oil. That would be actually really change the geopolitics around the world. Think about that. But that's for a different discussion.
Thank you.
Sure.
We had a question coming in the chat from AJ. Do big unexpected market downturns, like such as the one in March from a COVID, change your investing strategy? And also on that note, how did you approach the COVID downturn? Yeah,
very good question. So the businesses that I tend to buy tend to be very predictable. So I like companies that have, you know, for example, a company like Microsoft, right? They have two businesses essentially, which is Office and Azure, which is their cloud business. Both of them are highly predictable recurring cash flow streams. So when it comes to Microsoft, again, if you believe in the long-term earnings power, then every time the stock pulls back, you want to be buying because their earnings are going to grow over time, as long as you're not overpaying for those earnings. So that's how I think about a company like Microsoft. The other thing that happened is there was an acceleration in certain trends. So for example, food delivery. Now in the US, we have DoorDash, we have Grubhub, we have Uber Eats, but there's been massive consolidation outside of the US. There's two companies, actually there's a duopoly in China, which is Meituan and Alibaba. And outside of China, there's two companies. One's called Delivery Hero, and the other one's called Just Eat Takeaway. And those two companies are, you know, establishing a very, very consolidated market outside of China. And the U.S. is yet to be consolidated. But what's happened is, as food delivery accelerated post-COVID, these companies are becoming profitable faster. And once people are used to using these types of apps, I even know people now that are using Instacart that are in their 70s or 80s to get things delivered to their home. So these mega trends have accelerated. Look at Netflix and Amazon this year. So the winners are winning more and getting bigger and faster. And the companies like retailers, I mean, who's going to go to a mall to go to buy candles or going to go to a mall and shop? People are just doing a lot more things online. So the disruption is accelerating. And so I wanted to be on the side of the winners. And so more than anything, I would say I added to my winners or the companies that I like and I believed in, rather than initiating any new positions per se.
Let me jump in real quick. Sammy, regarding food delivery, are you familiar with a company called Waiter Holdings?
No.
You're not? Okay.
No.
That's a food delivery app. I wonder, it's a 328 million market cap. Is
too small for me.
That's what I was wondering.
Yeah,
what's your minimum market cap?
I usually don't invest in companies less than 10 billion.
Oh, wow.
I know a lot of 5 billion to 10 billion market cap companies also, but typically 10 billion and up.
Wow. Okay.
I saw a question about mistakes. I do want to talk about mistakes. One of the biggest lessons I've learned is you have to cut your losses, especially if you're an individual investor. You should have, and I'll tell you a personal story. My first personal investment in 1990 2000 was a company called Webvan. Webvan was one of the original grocery delivery companies. Some of you may remember. It was started by a guy from Arthur Anderson with a lot of fanfare in 99, 2000. Stock went public around 30. It went down to 7. I bought 1,000 shares at 7, and I sold them for 10 cents. And so I lost virtually everything I invested. But it was the best $7,000 lesson I could ever learn in my life. From then on, I decided anytime I lost 10 or 15%, I sold. And if you learn to do that and you have discipline, I think that's a very, very valuable and wise strategy. Similarly, when investing funds for my shareholders and the funds that I manage, obviously, when the market goes down 20%, I'm down 20%. I have to be fully invested. But if the market's down 20 and one of my stocks is down 30 or 35, is underperforming, I tend to sell and buy something else that I like more. So make sure you cut your losses.
Just to follow up from that point, how do you distinguish between a company that you know is fundamentally good, that you believe in, and I know that you mentioned that you buy more if there's a little bit of a discount on those. So how do you distinguish between when you should sell and when you should?
Excellent question. So it depends on the earnings. So Webvan didn't have any recurring earnings. So if you look at, for example, a Costco, right? I don't know if you guys know this, but believe it or not, about 70% of Costco's earnings come from the membership, and about 30% come from the actual food margin of the things that they sell in the store. So if you look about the membership, I mean, Costco's earnings are highly predictable. Amazon's earnings are highly predictable in terms of what they're earning now. Their future growth is uncertain, but what they're earning now. So what I've learned over time is I'm buying companies that I can predict their earnings with a good amount of visibility. Then when they sell off on weakness, I have conviction to buy them, because I know if I thought they were going to earn $3 next year and then $3.50, then $4, and the stock went from 50 to 40, and I believe in the $3, $4, $5, I'm going to be buying because I believe in those numbers. If you buy a very cyclical company, that $3 might be 150 and it might stay at 150 for 3, 4, 5 years. Who knows? But if you buy the good businesses that are very predictable, that tends to be a very good strategy to buy them on weakness, on sell-offs.
Great. Thank you, Sammy. I think we're going to end it there. We need a few minutes to go over some story trading stuff. So I really appreciate your time.
Of course.
Maybe we'll see you again in the future, and good luck with your portfolio this year.
Thank you, everyone. All right. All the best.
Thank you.
Take care. Bye-bye.
Thanks. So, guys, we just want to let you know this Sunday night, we have 2 presentations, Pitney Bowes PBI from Rob Mock and OneSoft Solutions OSSIF from Ashley. Also, we're going to find out the winner of the Trader of the Week this week, and you can participate in next week's competition. Now, if you're not a paid member, we got a special right now. You go to StoryTrading.com. We're going to run this special the rest of the day until midnight tonight. You can upgrade for just $20 instead of the $99, which we plan to eventually price our this offering at. So go ahead and take advantage of that special so you can join us this Sunday night. So also want to let you know, how do you participate in what we're doing? We're actually building our own app. We started designing our own app last week. And remember, what we're trying to do is level the playing field with Wall Street insiders through crowdsourced collaboration. You're going to have an opportunity to answer market surveys, comment on designs, comment on our features, and more. We're going to send an invitation out for people to participate in that process in the WhatsApp group. So make sure to go to StoryTrading.com, join our group so you can get involved in building this awesome fintech app. And also, we are raising money for our company. We actually just raised $110,000 to start our project building our app. We're raising $750,000 in this seed round. So if you're interested, you can get in on the ground floor. Just contact me at ben@storytrading.com, and we can talk more about that investment opportunity. And with that, I wanted to thank everybody for their time. Thank you for coming. We'll see you again Sunday night at 9 p.m. for our paid subscribers on Zoom. Thank you, everybody.